Hello, Smart Money Tree Podcast listeners. Welcome to this week's show. My name is Kirk Chisholm, and I'll be your host. I am once again joined with my good friend Doug Heagren. Hey, Doug.
Well, good morning again. Hey, Kirk, how you doing? Hope you're staying warm out there. We're getting blanketed with 2 to 4 inches up here in the north, and looks like more to come. Winter has set upon us. Well, of course, I think that's a nice segue to the winter that's setting upon our economy. What do you think?
Yeah, I think it's a great indicator. I just got back from Lake Placid. My son was in a hockey tournament. It's funny. You go back to the 1980s with the movie Miracle, which was such a transitional time period, and it's actually going to be the center point of my talk I'm giving in Las Vegas tomorrow. So for those of you who are joining us at President's Week in Las Vegas. You get to hear it live. Those of you who are not joining us, join us next year. It's a great event. But yeah, I mean, I think right now let's just throw it out there, Doug. I know we were talking about inflation. There's a big number that's changed and it's got everyone up and talking. What's on your plate? What do you want to talk about today?
Well, I think a couple things. I mean, we've been talking about before. I think housing is an interesting one to go back to because we're continuing to see some trends going on. I think for people that are listening, that one hits right at home. Just kind of looking at some information on kind of just dispelling some half truths that we've talked about from time to time. One of those things that I think is important to me. I saw some stuff over the weekend where people were posting about once again, it goes around like who's wealthy, what do people make, who pays the taxes. So I think there's some good half truths to talk about in that as well. And ultimately, as you said, all of a sudden, hey, inflation's gone. I think you could probably talk a little bit about what that really means. Of course, the headlines like to jump on everything that comes out better than expected, as if it's just great, right? So not as bad doesn't necessarily mean good, but hey, it's the news, and of course, they'll spin it however they want.
Yeah, absolutely, and that's a good segue. So let's just talk about the big news. It's not the election, although some people are spinning that in the direction that they want. The markets are up big, and a lot of that is basically due to the CPI print, which came out last week as a 7.7, which was a big drop from what was expected. And I think what the interesting part is we were in the eights pretty much for most of this year, and now we're 7.7. Woohoo! All right. Inflation's over. No, no, it's not over. I think it got people all excited because it looks like directionally we're going in the right direction, which I think pretty much started in June when it was 9.1. Then it went to 8.5, 8.3, 8.2, and now 7.7. So directionally, yeah, things are dropping, which is
Fourth straight month of drops. It doesn't hurt near as bad as it did, even though it still hurts.
right. But I think what's interesting, and I think this is the takeaway for you listeners, is that 7.7 in itself is not a significant number. What's significant is that the expectation was, I think it was 2 basis points higher. I think it was 7.9 was the expectation. So it was a lot lower than expected. And we talk about this a lot in the show. Is what's important is not what the data is, but what is expected. So the market looks at the future and backdates it usually about 6 months. So they're looking at the future and saying, oh, we expected it to be this, and actually it was better than expected. So all of a sudden the market rises. The market was lower because it expected things to be worse. So that's really all it is a change of expectations. So we see a jump in asset prices. Of course, the election's over, with not much fanfare on either side, I must say. Everyone's got their 2 cents, but I think at the end of the day, I think it's still being counted, Doug, isn't it? I mean, I was away for all week, but is it finalized in the House yet?
For the election, no, it is not finalized in the House yet. There's still a couple of campaigns that they're working through. By the way, I love some of the comments that are coming in. Inflation gone? That's a joke. Do we really believe that? And I think that's exactly I'd say the sarcasm that I hear there is very much something that we both feel as well. But no, the election's still working through. I think there was a couple Senate cases. I think they've pretty much called, from what I saw, the Senate is not only going to maintain Democratic control, but unlike a 50-50 split, I think from what I've seen that the Republicans lost one, which now puts the Democrats in a true majority, not a tie, which was, gave them a majority because the VP was a Democrat. But now with a 51 share in the Senate, that means they control the committees. So the Democratic Party will have more control of the Senate. But I believe that the House, if at least at the last I saw, I don't think it's settled out yet, but I think that the Republicans have firm control of that. So there'll be a little bit of balance coming.
Yeah, and just for the commenter here, yeah, inflation gone. No, it's totally a joke. The whole point of this is I think that we have certain expectations. The market has certain expectations, and there's a chart here I'm going to show on the website, but let's see, it'd probably take too long to share here. But if you look at the Fed funds futures curve, about 4 months ago, the expectation was that the Fed's fund rate would peak in January and then start to decline. As of right now, I think it looks like it's about June. It would peak in June, and then it would start to decline significantly. Now, I don't know obviously market participants are the ones that are creating these prices, right? It's not somebody manipulating it. There are literally people out there betting in the futures market saying, this is our expectation. Now, I don't know who these people are because every single person I've talked to in the institutional world has also the same thing, that this is wildly inaccurate. And no one that I've talked to is saying, oh yeah, that's realistic. Everyone's saying this is ridiculous. Like you've got inflation at 7.7. You got a Fed funds rate. What is that now, Doug? 4.25. You got a Fed funds rate about 4%, I think. And you've got and we still have to get up to the inflation rate. We haven't even gotten to the inflation rate at this point. 7.7. So now you got we'll call it 3.5% to get in the ballpark of where inflation is. That's a long way to go. And somehow this is just going to rise another 75 basis points to, well, let's call it 1% is approximately for what the Fed funds future rate is showing. It's actually down about 25 basis points from last week. So the point of the curve is really to show that all of a sudden the expectations are dropping just because of that one inflation print. Now, here's something to think about with inflation. Inflation is a year-over-year number, right? So every single month, we're looking at last year's number and saying, is it more or less, right? Now, a lot of people think we're going to go back to the way things were a few years ago before COVID. We're not. We're not going back there. This is not transient. This is structural. And this is something you all need to realize is this is a structural problem. It is going to be with us. Even if inflation goes down, prices are still going to be higher. Wages have not gone up this much. So what we're going to start to see over the next 5 years is inflation is going to stay elevated. It might be 5 or 6% a year. That's kind of my ballpark for where I think it's going to be. You're looking at 5 or 6% at a minimum. Now, if the government decides to step in and help, then what's going to happen is it's going to send inflation higher because whatever they help with is going to distort the market as it always has in the past and as it always will in the future. This is kind of a law of economics, right? That the government is going to try to help people and it's going to have unintended consequences. This doesn't matter who's in power. It has nothing to do with it. It has to do with politicians appeasing their base. Look at rent control, price fixing. They're doing price fixing in Europe. That's not going to work. Oh yeah, hey, let's cap utility costs. Let's cap electricity at a certain price. That just means you're not going to have any electricity because they're not going to produce it. They have costs too. So I think what we need to realize is that there are a lot of things that are going to happen over the next few years, and this is going to be ebbs and flows. So I have been predicting for a while that the inflation rate is going to start to come down. I don't think it'll go lower than 5%. I think probably 5 or 6 will be a number, and then it will start to pick back up again because that's just the way it works, right? We're not getting rid of inflation for at least the next 4 years minimum. Everybody I talked to, I said, 4 years, they started laughing. They're like, yeah, minimum. That's a miracle if it hits that. So I think we're probably looking closer to 10 years, but this is just something you just have to acclimate to. This is a new paradigm and you need to get used to it. So Doug, let's talk a little bit about you. There's a bunch of other topics you want to talk about, Doug. Where do you want to start?
Well, I wanted to kind of update. You asked on the number. So the current Fed's fund rate is right at 4. So that's what settled at. But a year ago, it was 0.3 or 0.25. So if that doesn't give you an indication of how much change has been over the last 12 months. And the other thing I want to clarify too is what's funny is like, is inflation here to stay? Absolutely. Inflation never goes away. We're just hoping it gets back down to nominal levels of, an easy, predictable 3%. But, some people think inflation's disappearing. The other thing I think that I want to just add on that is, and because one of the reasons I think the markets are reacting, yes, we talk about pricing in and it came better than expected. But I think that we've seen this before, that this inflation number coming in less than inflation was predicted to be immediately creates a market response of, oh, we think now that means that the Fed isn't going to raise rates the way we thought. One word of caution. And again, I don't sit on the Fed. I don't talk to them. But if we've listened to what has come out of Jerome Powell's mouth previously, and that is, he has said he's going to keep raising rates to fight inflation. And the last time that inflation came in a little bit less than expected, jobs reports came in better than expected, everybody reacted and thought, wow, they're not going to raise rates. And he came out at Jackson Hole, ticked off, referencing it multiple times. And what did he do? They came out and raised rates again. So I would say just prepare with a little bit of caution, because what's going on with this reaction here, this overreaction to this number, does not mean that the Federal Reserve has changed their tune to any capacity. And that could mean a reverse situation, because if the market overreacts thinking that they're not going to raise rates and then they still do, you could obviously have a severe reaction the other direction on the market. So I would proceed with caution.
Okay.
I know you love the show. I do get a lot of love mail and hate mail from people who listen to the show. I certainly prefer the former, but I have a thick skin if you want to send the latter. However, I do need to ask you a favor. We're looking to expand the show with a lot more resources and high-end guests. You're going to love what we have in store for you in the upcoming months. However, now I need your help. I need 5 to 10 minutes of your time to help influence the direction of the show. We're doing our annual listener survey to help understand our audience better. I know you're busy with your life. Well, I am too. My kids are going back to school, and that leaves me less time for other things. But as a listener of the show, I could really use your feedback. I'm not the government, so I'm not asking you to work for free. So in exchange for 5 or 10 minutes of your time, I'm going to give you a gift of over 100 million Zim dollars. That's right. I'm giving you a gift of over 100 million Zim dollars in exchange for 5 to 10 minutes of your time. Go to moneytreepodcast.com/free money to get your free money today.
So let's talk a little bit about housing, Doug. This is our perpetual whipping boy on this show. What are you seeing for housing?
Housing is completely stalled. Affordability has deteriorated at a much faster pace than any point in the last 30 years. There's some charts that are out there that, that we can be posted, that basically what's happened is we have this massive contradiction, because what's happening is that while the people who have homes that are selling, most of them are what we call free and clears. Okay. They've aggressively worked to pay. They've either been in their home long enough that they've paid it off, or they've aggressively overpaid on the house or paid on their mortgage in order to pay it off quickly. And this creates a problem on a couple of fronts. First of all, that is not the situation of the people that are buying. 80% of buyers last year used a mortgage. That if we look at the current interest rates that are out there, it absolutely freezes them out. Okay. The first-time buyers, the typical first-time buyers, about 33 years old. Repeat buyers are 56 years old. Okay. Buyers are younger. Older people are not going out there trying to typically get the first-time home, which means that the buyers have to get a mortgage. They don't have the cash predominantly to go in as a cash buy. Now, the sellers, on the other hand, they don't have a mortgage. Now, what could be a problem for a lot of the sellers is, and this is something I've stressed about if anybody's listened to me, is that one of the challenges of overpaying on your mortgage is, while it may feel like you're giving yourself a huge advantage by having that mortgage payment paid off, you're also transferring your wealth from liquidity to illiquidity. Once you give it to the bank, you haven't created any value in the home. You've just created equity. Well, equity is only good under two circumstances. One, sell the home. Two, get the bank to lend to you. Okay, that's it. That's the only way you can use the equity. So if a lot of these individuals who own these homes are trying to get out of them, maybe trying to move, but they have not taken that money that they've paid extra on the mortgage and put it to the side, right? Kept the liquidity. They could be stuck because now they're trying to sell to get equity out of the house, talking about maybe retiring and downsizing, but they haven't created what I call a balanced wealth strategy. Paying extra to the bank does not increase the value of your home. It just sends and transfers their money away. So if they're thinking I'm going to downsize and have that liquidity for retirement, that's a problem, because now if the majority of buyers are younger and the majority of buyers are first time, and we talk about people need homes, right? But 3 to 7%, Kirk, is a massive, massive spike on not only the cost to acquire those loans, but it's also a massive spike on the amount of income that a buyer must show the banks in order to be approved under, let's face it, tighter monetary policy. And since the Fed isn't backing the banks don't like to take risks. So there's going to be very little money, I think, going to buyers to buy. And at the same time, sellers may be trapped with an illiquid asset that they can't get out of. And it is effectively frozen the housing market.
Yeah, I always go back to this phrase that I remember from when I was younger, is that banks will lend you an umbrella when it's sunny and they'll take it back when it's raining. And, it's so true. I mean, banks are happy to lend you money when times are good, and when times are bad, they do the exact opposite. I think they've actually gotten better since the great financial recession. But, I want to get into some stats here as we kind of look at these things. So first is, the share of first-time homebuyers is an all-time low. And I think, getting along to what Doug said, is the reason it's an all-time low is if you look at, let's say, the last few years, rates were down to 2%, I think they were last year, and home prices were through the roof. I mean, you could barely afford home prices, but they were really high in comparison to what you were paying for monthly payments. Now, the problem is we've gotten to a point where it was really expensive. Like, for most people, they couldn't afford the typical home that they would afford based on their salary, unless they got help from mom and pop from the baby boomer generation giving them money. First-time home buyers definitely couldn't afford it because everything was well out of their price range. So if you look at this equilibrium of buyers and sellers, they typically fall in this range. And in the last few years, even though mortgage rates have gone down, the prices of homes really went up here. So people still couldn't afford it because they weren't making any more money. So what happened, and you look at first-time home buyers, a good example, right? First-time home buyers, they have to save up 20% or get help from mom and pop, but most people don't have that. So you're saving up 20%, and then you're going to go buy a home that meets your specifications for monthly payments. Well, saving up 20% is hard, right? If you're looking at a $500,000 home, you're saving up $100,000. Most people, that's not easy to do. If you're in a home and you're getting that equity appreciation, you can take that and roll into a new home, which is what a lot of people do. But for new buyers, they don't have that luxury, so they have to start really small. The problem is everything is priced out of range. Now, you look at this, basically this, here's what I can afford, here's the prices, right? We already have a disequilibrium. Now, on top of that, prices are staying here, but people can afford a lot less because mortgage rates have gone up. So effectively, mortgage rates, you can afford half the home that you could before. So you start up here and it's gone way down here. So this discrepancy of what you can afford has exponentially increased. So I don't know how there's anybody buying a home unless it's for all cash. I mean, yes, you could, but most people look at it and say, well, I don't know. I was thinking I was going to buy this really nice house. Now I got to buy this really crappy house. I don't know. I mean, are people really doing that? I mean, I guess if you have to, right?
And here's the problem with the all cash, Kirk, is, I mean, let's say you've got all cash, but if you have all cash and you still own another house, do you want to buy another house without the ability to sell the house you have? And if all cash you were going to have was because you were free and clear on the house you now can't sell, I just want to interject because I was just kind of looking it up. I've talked about this a couple times. I got a house that was down the street from me. Now with 2 houses down the street, one of them sold a year ago for about 1.3. They're about the exact same size. So this neighbor of mine was looking to sell his house, going to move down, buy a boat, live in the Caribbean, and he waited a little late, right? So now he puts his home on the market about 3 months ago or so for, I believe, 1.1. Now Zillow says the home is worth 975, and if this doesn't tell you about, I'm sorry, this estimate I guess on it is 925. So if this doesn't tell you the inaccuracy of these home value gauges, well, they posted for 1.1, no movement. They moved it to 975, no movement. I believe they moved it to 900, no movement. Off the market. He can't get out. His entire retirement strategy was to sell this house, take the liquidity, and go move. And now he's stuck. And Zillow still says it's worth 925. Listen, I'm paying on a property taxes here that the county says $100,000 more than I paid for my house. Okay, listen, these numbers don't mean anything. It all comes down to what people are willing to buy, and people aren't buying, and they're stuck. New buyers don't have the lending, and old free and clear sellers can't get the liquidity.
So you raised a great point, which is very early in the conversation right now because we've just hit the peak and things are starting to come down, even though prices aren't moving. What's going to happen when all these towns who are expecting a certain amount of tax revenue from housing are all of a sudden going to get 20%, 30%, 50% less? What happens if your tax revenue, you have 50% less to pay for schools? Now, for some towns, they have a lot of commerce and a business district, and they get a lot of taxes from them. But most towns get a large portion of their taxes from homeowners, and that's how they fund their town, their infrastructure, their government, their schools. I mean, schools in most towns take like 75% of the budget, so it's not insignificant. And now you're going to have 50%, 20 to 50% less in the budget for schools. I mean, schools are already get a lot less revenue than they should. I mean, every town certainly fights and claws for more revenue every single year. But talk about a big drop in revenue. That's going to really hollow out a lot of different towns. So it's just something to be aware of. We talk about this paradigm shift. For 40 years. We've had wealth creation and abundance creating across the globe. And now it's starting to reverse. It doesn't just reverse in asset prices, real estate, and stocks. It affects everything. Everything is interrelated. Taxes are interrelated with, whether it's capital gains or whether it's funding schools, all of it's interrelated. So you're going to have a huge problem if this persists, and it is going to persist. There's no way that this is going away. And I did make the joke on the title of this, inflation's gone. It's obviously not gone, right? Now, I do want to point out that there's a part of this that has always been the case, and people kind of always complain, well, is it inflation or deflation? It depends what you're describing, okay? So on one hand, we have inflation based on the CPI, right? On the other hand, we have deflation of asset prices, right? So we have asset price deflation. So you can have both. And I know people sit there and they say, well, it's gonna be one choice or the other. In many ways, it's gonna be both. It just depends what you're describing. So we can have a CPI of 10%, and we can have deflation of assets, deflation of wages. I mean, next year we'll probably have stagflation. That's what's been predicted, probably later in the year at this point. But we'll probably have stagflation, which means economically we're stagnating, wages are stagnating. We could have wage deflation at some point if there's a lot of layoffs, which there is starting to be. You could have deflation in a lot of areas, just maybe not on the CPI. So I think people just need to be aware that there's like two parts of inflation. And if you just think inflation equals gold goes up and cash goes down and all these things that are so obvious, they're not always obvious. I mean, we've looked at the U.S. dollar. The U.S. dollar has skyrocketed for most of this year. Yet we have inflation. But our dollar is worth more globally than it has been in a long time. It won't stay that way because it can't, because globally other currencies are related to our currency, and an expensive dollar means that it causes a lot of problems globally for people who have debt denominated in dollars. Now, for their economies, it's a good thing because they can sell more goods and services cheaper to us, and so But the point I'm making is there's a lot of interrelations here that you need to be aware of, and it's not a simple thing. I want to talk about one more quick thing, Doug. We're talking about before we get into another topic, which is rents. We have a chart here, the 25 most expensive metropolitan areas in the country, and it's not necessarily in the areas you'd think. But if I look at the numbers, Boston is number 3, New York, San Francisco, Boston, San Jose, LA. So a lot of California cities, Miami-Dade. But then there's like number 23rd is Hartford. I spent 4 years of my college life in Hartford. I don't know why it's expensive. Nobody lives there. Nobody works in the city. I don't know. They must be looking at college campuses because there's no way that's on the list. But year over year change, rent's gone up 5%. Some areas up in Oregon and Washington, it's up 14%. Rents have gone up a lot. Why? Why do you think, Doug? Why are rents going up so much?
I would say that people need a place to live. People need housing. They got to end up somewhere. And if they can't get a home, then what do you think the alternative is? Well, I mean, I've seen some images from some cities. I mean, the alternative is to sleep on the sidewalk, but I don't think that's the ideal alternative.
California, the weather's beautiful. That's why people live there, because of the weather.
Right, exactly.
No other reason, but that's
Northern California, maybe. Not so much.
So I think the important point is rents are going up. So what we're seeing now is we've seen a discrepancy in affordability, right? People can no longer afford what they want to afford. And rents have gone up because people have to live somewhere, as Doug said, and it's getting more expensive to live there. So at some point, that's going to cap out. And then at some point, the home prices are going to find a more of an equilibrium. When we look at it, if you can't find a buyer, then a house is not worth what you think it's worth, right? The buyer and the seller meet, that's what it's worth. And effectively, it's a lot lower, which is why people are probably not selling and they're staying in their homes longer. Maybe they're renting the house out and they want to get a higher rent to be able to afford the payment that they still have. So there's a lot of these dynamics. Real estate operates slowly, and this is the reason. If you look at 2005, that was the peak of the real estate market. 2008 was when we saw the implosion. That was 3 years. And rates are going up a lot slower. So it's been about a year, not quite, but almost a year. So I would say we have, another 6 to 12 months, and we're going to start to see things really become problematic in the real estate market, or it's going to be obvious. It's a problem now, but it's going to become more obvious, especially if mortgage rates stay at 7.5%, or they even go higher if inflation creeps up. So I know a lot of people talk about, well, if you remove this and remove that from the CPI, everything's fine. Yeah, and people also said, well, if it wasn't for used cars, when we had that first high inflation print last year, it would have been fine. Well, inflation's kept going up. So I don't think it's just one factor. I think you can pull out anything you want and create a half truth from it, but it's not necessarily going to be indicative of truth.
And Kirk, I want to add one thing about this, because I think you made a good point. So if right now banks aren't going to lend to people, can't get the financing, can't buy, you can't, to use to buy, and people living in houses are going to be incredibly cautious, if not resistant and hesitant, to sell the house when they think the value is down, right? So that's where that real estate moves slowly. But how slowly is going to be dependent on what the economic household structure is. Is someone's financial house in order, right? Because if they're in, again, and we've seen this dynamic, people have rushed to pay off their houses. If they have created a lack of liquidity in the house and they still have a mortgage and it's at a low interest rate, it's going to take a long time for that person to be willing, if they even can, to sell a house at that low interest rate and potentially have to buy something at a higher interest rate. That's a problem. If they were relying on the equity in that house to be able to move to their next stage of their life, like my neighbor, well, now they've seen this significant reduction in values. Are they going to be willing to sell that house? How long is it going to take for people to just accept this new reality? And then with rents going up, it is very possible that for a foreseeable future, there could come a point in which housing is unaffordable and rents are unaffordable. And that leads to a really, really big problem because that makes housing completely unaffordable. And that means we could see a spike in homelessness. We could also, but then again, maybe I'm going to look at the positive side. Maybe we just see a spike in purchasing of camper vans. So I might invest there because people got to live somewhere. But right now we are in a time we have not seen in my lifetime where affordability to rent and affordability to purchase a home or purchased housing may both be outside the affordability of the masses.
Yeah, so I want to dip into some other areas here. I know we beat the housing dead horse every week, but I want to kind of show a few charts here. So one of them was largest employers of every state. Doug, did you know that there are 22 states where Walmart is the largest employer out of all employers? That's crazy.
I didn't realize there was only 22 states. Oh, they're not the largest employer in every state. Sorry, I got confused there. No.
You should run for office, Doug.
Well, thank you. You can be my campaign manager, Kirk. No, yeah, you know what? In a way, I'm not surprised because of the sheer volume of employee base that retail supports, right? You think every single retail location has got dozens, if not, I'm talking major retail location, but if we talk, if you break it all up, it is probably the number one employer in maybe besides the food industry, which is still a direct to consumer retail if you think about it. But it's the number one employer in every state. Is that, and if you go to like the major box stores like the Walmarts, every one of them is going to have 100 some employees. If you look at the sheer number of employed by Walmart, Target, grocery chains, it's an insane number of employees. So now you think of how Walmart started, right? Sam Walton looked at who was dominating the industry. There's this place, you may have heard of it, Kirk, called Kmart. I'm not sure if
I've heard of it. Yeah, in passing. Yeah.
Yes, well, I think it's a good way to say it because I've heard they passed. I think the last Kmart may have just closed down, or it's down to one. It's a really sad demise of what at one point was the industry leader of big box, retail chains of multi-sale, like department, kind of retail chains, and basically Sam Walton said, look. They're only in cities. They're supporting these major populations. So let's go rural and let's open up where there is nothing. It was an incredible gamble. He was incredibly successful at it. So you look at a lot of the states where Walmart is located on this, there is a lot of rural areas outside of, maybe a limited number of concentrated, if they even have, like, for example, if you go to Montana really doesn't have a major metropolitan area, right? But Walmart has been the lifeblood, love it or hate it, but the lifeblood of consumer access to goods in probably 80% of this country.
Yeah, it's interesting looking at this chart. So there's 22. Walmart is in 22 states the largest employer, and what's odd is there's no close second, but the second one is actually healthcare, hospitals and healthcare. 15 states, including my own state, Massachusetts, which is Partners Healthcare. Basically, hospitals, healthcare have been the biggest employers in many states. I don't know if that's scary or not, Doug. If you think about it, I think it's great that our healthcare is improving, but it kind of wonder, like, is this turning into this monstrosity that just can't be tamed? You've got tons of people in the healthcare system, and people are getting less healthy, and they need more care. And I don't know. To me, it just seems like it's a self-supporting monster. And I don't mean monster in a bad way necessarily, but just this beast. It's like any sort of big institution just becomes bigger. I know locally here, a bunch of the healthcare companies are nonprofits, but they just keep expanding and they just keep acquiring smaller hospitals. Now you've got this like one big monster chain, And is that healthy? I don't know. I mean, to me, it's a nonprofit, so maybe it doesn't fall under antitrust laws. But to me, it just seems like this may be becoming a problem.
Well, the irony is, so I'm talking about my state. So I'm located in Minnesota, and of course, we have probably the most reputable hospital in the country, which is the Mayo Clinic, and it is the number one employer in Minnesota, which is ironic because it's about an hour and a half, 2 hours outside the city. But on top of that, what isn't noted in this is the number one company in terms of size and revenue in Minnesota, with not even close second, is United Healthcare. Okay, so if you talk not only the number of people employed, but now you start getting in numbers. I don't know if it's still the case, but I grew up in Ohio. Silently, for all of the major brands in Ohio, the number one revenue company in Ohio for a long time, and it may still be, Cardinal Health. And here's the irony when we talk about retail. Cardinal Health actually started as a grocery distribution company. They originally were distributing, foods, goods to retailers. But what they realized is that there was a void there of companies that were willing to distribute pharmaceuticals because drugstore cowboys, right? You don't want to slap your name on the side of the truck, say, "Hey, by the way, I've got fentanyl, come on by," right? So Cardinal Health basically grew out of nothing to be the largest revenue producer in Ohio with unbranded trucks. Now, these days, you will see Cardinal on the side of trucks because now they've gotten into everything. They've gotten into pharmaceutical development, equipment, everything. It's an absolute multi-conglomerate. But I'm with you. I'm actually kind of surprised that you're not seeing in those states where the largest employer is Walmart, that the second largest employer is the healthcare, because as we know, food deserts and the lack of and the processed foods, and America's been getting bigger and bigger and bigger and unhealthier, and diabetes. I mean, we've got an aging population that hasn't taken very good care of itself. And we had a conversation over the weekend, actually, because there are some major companies out there, just kind of, I'm not sure how much is public on some or not, but there are major companies right now that are in the process of spinning off their healthcare division. And in that conversation, one school of thought was maybe these companies must be spinning those off because they are, maybe it's not profitable, it's overhead. I said, no, the reason they're spinning it off, because if you're a company that's spinning off a division, it's not generally because the division's terrible. You'll just wind it down. If you're spinning it off, it's because you're going to continue to own a lot of shares in that new company. It's kind of like when Ameriprint Express Financial Advisors spun off Ameriprise. They basically went to Jim Cracchiola, said, "Here's $10 billion. Good luck." Right? Well, I mean, American Express didn't just not own anything of Ameriprise. They were a major investor in it. But what they saw is that division had so much opportunity and profitable potential, is that by standing alone and blazing their own path, they could become much bigger than they ever would become as a division of this other conglomerate, which obviously has a completely different focus. And it still now becomes no overhead, but complete revenue stream to the company that spun it off. It's the same issue with healthcare. Healthcare is such a booming business. Every day, more and more people are becoming unhealthy. And that was before COVID. That's just diabetes, diet, aging, etc. And these companies realize how much money there is to be made in this world. And it is not going to change. I don't think it's ever going to change, because we have not, even though we've talked about being healthier and this is a little controversial, Kirk, and I'm sorry, but over the last couple of years, one of the number one correlations between death and COVID was obesity. Okay. So and it became very apparent that those that are not healthy to begin with have much more precursors to death if anything goes wrong. I mean, but yet at the same time, instead of fighting obesity, instead of going into where we need to be concentrating on being healthier, it almost became taboo to even suggest it. So we've kind of come to a point where instead of encouraging being healthy, we've been willing to now come out and just say, you can't talk about that. It's okay being unhealthy. And that attitude right there means healthcare is going to have an incredible opportunity indefinitely. And I don't see it changing. So I think I think it's going to be one of those areas potentially for investing that long term is going to have a lot of opportunity.
Yeah, I would agree. Unfortunately, right? I think everyone should take their health into their own hands, and obviously, we're not making medical opinions here, but I think unfortunately we've gotten to a point where people are reliant upon a system that's reliant upon us, right? And they're not there to fix the problem; they're there to alleviate the symptoms. And it is what it is. I don't personally like it, but I think everyone's got their opinion. So I want to dip into the second myth here, and I want to share this because I just think it's hilarious. I saw this, but this is the essence of social media debates. And for those of you who are listening, you can just go to the website and you'll see this once it's live. But effectively, this is what we're all seeing. The problem with investing myths is effectively that you have people seeing things from different lenses, and we have what we call half truths. And half truths are things that are true some of the time, but not all the time. This is a good example, right? Depending on how you look at it, sometimes something's true, sometimes it's not. Now, I want to share this presentation, or at least one slide from the presentation I'm doing this week, tomorrow, which is our second myth, which is cash is dangerous during inflation. Now, for those of you who have been following this weekly, you probably heard this before, but one of the things I hear nonstop is cash is dangerous. Inflation is going to eat away at your cash. Cash is the worst thing you can invest in. Now, I look at cash. Cash is a strategic play. It is a choice, right? You can choose to be in cash or not. Ray Dalio came out a few months ago and said cash is trash, right? Well, I would disagree. Cash is king. If everyone has lost 50% of their wealth in some assets and you're sitting on a pile of cash, you're the king, right? Basically, your cash went up 100% if everybody else lost 50. That's kind of I know it's a different way to look at it, but that's how I choose to look at it. You can look at it a different way if you want. You can look at it as you just lost 50%. I choose to say, hey, my cash just doubled in value because now I can buy twice as many shares of that thing that dropped 20% or 50%. So Ray Dalio talks about cash is trash. I disagree, although he is a lot wiser and smarter and a bigger name than me. So I assume if he came out and said cash is king, you'd see this tidal wave of people selling, which is not a good thing. So I think he does have a responsibility to the public. So I don't want to trash him. I think he's got other reasons for saying it. Not all nefarious. So also want to point out basically the difference between real and nominal returns. And I don't want to turn people off by using these terms. I hate using technical terms with people because they just kind of tune out. But the difference is nominal returns is basically the price you see on your screen. Real returns is if you include inflation. So we're going to do a simple picture here that's going to show you what I mean. These are the returns as of the end of Q3 of 2022. The top row is the return. Obviously, the big indexes, S&P, NASDAQ, 30-year treasuries, gold, and real estate, and cash. And if you look at the end of the third quarter, it's pretty bad. The S&P is down 25, NASDAQ's down 33, 30-year treasuries down 30. I mean, quote unquote, safe bonds down 30%. Gold down 8, and real estate down 30. Oh, cash is down 0. But then you include inflation, which as of the time I put this was 8.2%. So 8.2%, yeah, you could say cash. Yeah, cash was down 8.2%. Oh, but you know what? The S&P was also down 8.2, and so was the NASDAQ and the 30-year treasury and gold and real estate. So if you take the real returns, S&P's down 32, NASDAQ's down 41, 30-year treasury is down 38, gold's down 16, real estate's down 39, and cash is down 8. So, you could say, yeah, it's still down, but it did a heck of a lot better than anything else. So what I choose to do is I don't like using real returns. I think it's kind of this term that's used to create a narrative. And we all know about narratives because the news does it to us every single day. They create a narrative to sell a point that they want to sell you on. And it doesn't mean it's true. It just means they want to give you a narrative, which is why I stopped watching the news about 20 years ago, because there's just nothing good on the news anymore. But let's talk about the narrative. What they're trying to tell you is don't invest in cash because it's going to devalue over time. which is true, right? Just like everything else. If you have positive inflation, everything is going to go down in price, in value over time. But what I want to bring your attention to is the fact that this affects everything equally. Look at that second to last row, 8.2. Everything is down 8.2. So you can pretty much remove it from the equation because it affects everything equally. So forget real returns, look at nominal returns. It's simpler. Now, I'm not saying if you're an institutional investor, you should disregard it, right? That's not what I'm saying. But for most people, if you're just looking at the numbers, look at the nominal number. Don't look at inflation because everything is going down the same. So if you just look at the nominal numbers, cash didn't lose any value. That was the best return of those 5 other indexes. And that's what you should focus on, is not what the return is after, because it's the same. You're just confusing yourself. You're adding another useless layer onto things to look at. Now, over time, it's really important to understand the impact of inflation, because inflation will eat away at your purchasing power, which I would say over the next 10 years, you should get real used to the fact that inflation is going to be pretty high. However, we're going to have bonds that are going to be high enough that should compensate for a lot of it. We're not there yet, right? I mean, I think it was a few months ago, I got a 3.8% bond, like a 3-month treasury. I think you could probably get up until the CPI print, you could probably get 4.25, 4.5. That's pretty good considering what we've seen in the last 5-6 years. But what's important to understand is that, yes, inflation is happening. You need to be aware of it. But if you're making your investment decisions based on inflation, you're going to make bad choices, because you're going to start thinking about, I want to make it back. I need to make back that return that I lost. And that's what people say in the casino too. And you know how that turns out for most people. It's really a bad psychological mind frame to look at things. That's why I like looking at it this way: is let's simplify life, look at the nominal returns, and look at cash and say, hey, cash did pretty well this year. That was one of the best performing assets, only because it didn't change in value. And that's assuming that your cash didn't make any sort of yield, which now it is. So just something to think about. This is another investing myth that we're busting today, and investing half truth. What are your thoughts, Doug?
Well, Ray Dalio has done okay. I think he's moving slightly into a level of prosperity. I think he's worth $20 billion, some chump change. But there's another gentleman who is on the list that's worth a little bit of money. I think his first name's Warren. Gosh, can you think of anybody named Warren there, Kirk? I'm struggling.
Yeah, I know he lives in Omaha, but yeah.
Yeah, Omaha. That's it. Right. Warren Omaha. Warren Omaha was sitting on $30 billion in cash. $30 billion. And while it was considered a drag for several years, and he continued to get these questions from people as to why you would be hurting the profits of Berkshire Hathaway to sit on all this cash, he would continuously say that the number one reason he sat on it is because I've got nothing really great to invest in, and it gives me options, right? Well, he's taken advantage of those options this year. He's put a lot of that money to work, but he's still sitting on a ton of it because he's patient and he waits for opportunities. He waits for opportunities to arise, and he takes advantage of it. I'm still seeing all of the news that's out there about how Warren Buffett just tells everybody just to buy the S&P 500 and that's it. And listen, there are some arguments that if you don't know what you're doing, it's good to just invest. But at the same time, follow what he's doing. And he understands that there is reasons to have cash. And that has actually turned into a bull case, because this year, with yields topping 4%, Kirk, not only has cash not gone down, but imagine the math. Okay, do that quickly in your head here. 4% on 30 billion, right? 0.04 on 30 billion is a lot of money. And we are looking at, something like, around $1.2 billion earned off of that cash. So as interest rates go up, yes, inflation is going to be an issue. But interestingly enough, is that cash tends to earn more too. And here's the thing. A year ago, a lot of people have lost their wealth. I think there's a gentleman in this imaginary currency. What's it called, Kirk? That's this currency that's out there. I mean, Buffett doesn't like it. But I think he went from like $20 billion to zero overnight because of a recent crash. Warren Buffett, in this economy, where we've seen tremendous decline of net worth amongst individuals who own different companies who are struggling in this market, actually saw his net worth go up from like the low 90s to about 105 billion. And that's sitting on 30 billion in cash. So I don't know. Guy's an idiot. I quit. I give up on him. Doesn't know what he's doing. Doesn't know what he's doing, Kirk.
It's interesting because there are times certainly when we all sit there and say, wow, he's a genius. And there are times where we say, wow, he looks like an idiot. And I think what's important to take away from this is not whether he's smart or dumb. It's whether we're looking at it the same time frame that he's looking at it, right? You could look at anybody and say, wow, that was dumb or smart. And then in hindsight, 10 years later, you could say, wow, that was the opposite. I really got that wrong. And I think we all do this every day, right? Let's say some news comes out and we immediately jump to judgment, partially because the news gives us that judgment. They say, oh, this is X. And it's still what they call the fog of war, right? Something comes out, some politicians getting railed against something stupid they did, or, they're, let's say, doing something illegal. And then you find out, a week later, like, oh, that was just fake news, or it was totally misunderstood, or whatever, right? Like, you don't know when news comes out whether it's true or not, and the news doesn't. Yeah, and I'm not even claiming that they have nefarious purposes. I'm just saying this is typically what happens. News comes out, there is a rush to get the news out there, and then once it's out there, people make their decisions even though they're wrong. And I think a lot of public figures have gotten lambasted of this, and it turns out that it was totally inappropriate. But that's what happens in this news cycle. So I think when we look at somebody like Warren Buffett as an example, he has a lot of his time frame is much longer than ours, much longer. He's looking at it in decades, whereas we're looking at it as day to day. So I think that the takeaway here is that people like Warren Buffett have gotten successful for certain reasons. He's successful because he's looking at things in the right way for his investor psychology and for his strategy. And also, you should take away that there's a reason he has cash. One is liquidity, because he needs to pay. They need liquidity if they're going to pay out. Their people who are insured if there's a claim. But also because he has nothing to invest in, and I can't blame him. Here's a guy who came in with billions of dollars in 2008 and 9, bailed everybody out, and made a boatload of money. And he wouldn't have done that if he wasn't sitting on a pile of cash. So it's very normal to expect somebody like him to have a big pile of cash. And I think what we'll see in the next 10 years is he's going to start to use it. His best investments were made in like late 70s and early 80s, when valuations were as cheap as they've been, I don't want to say ever, but close to ever. And those are the best times to buy. And I think he's smart enough to realize that, hey, I have a bunch of value stocks. They're going to do okay. And I'm going to protect myself with a bunch of cash, and I'm going to go buy things when they're cheap. And he's going to go run around like a kid in a candy store. So in the interest of time, I know we got to wrap it up. I know we talked about this briefly last week about Sam Bankman-Fried with the FTX crypto market has not imploded, but certainly his has. And I think there's still, we just talked about the fog of war, it's still the fog of war. When it first came out, there was news and it's changed. So we don't fully know. I know they're filing for bankruptcy as far as I'm aware, but we don't fully know. And I think this is a story that's going to keep unfolding, and it could turn out to be something significant like a Bernie Madoff, or it could turn out to be something that's just more accidental. We won't know, but I don't want to unfairly paint people in a bad light. But I do say that this is an indicator of like what we saw in 2008 and the early 2000s. When you see one bankruptcy, you see one implosion, you tend to see more, because this is where the shakeout happens. And it's actually a good thing. People say, oh, the crypto market, the blockchain is going to implode. It's actually not a bad thing. It's a really good thing, because it shows that as Warren Buffett said, when the tide goes out, you see who's swimming naked. This is what's happening. You're seeing who's swimming naked. And at some point, all of those naked people are going to be gone and everyone else is going to be solid. And that's a good time to invest. So don't rush to jump in with both feet. Just be cautious. There's still a lot of time and a lot of shakeout that has to happen. But I think we're going to start to see there's going to be more shakeout in these markets, and it'll give you great opportunities to invest at dirt cheap prices for those of you who waited and were patient. Now's a good time. So Doug, we're going to wrap it up here. Where can people find more about you?
Thanks, Kirk. You can find more about me at www.procollegeplanners.com. One of our major focuses is to help clients who have students that are going to be planning to go to college. So generally working with families with freshmen through seniors to pick the right college academically, financially, socially, put a financial plan around that. College is expensive. It is one of the great wealth transfers for most families. Most families go about it wrong. Most families overpay. And in the end, most families end up with their wealth hurt more than it should be. So avoid those wealth transfers. Learn how to not lose money unknowingly and unnecessarily. We can help you put on a path to make sure that your child has an extraordinary future, but ultimately your future will be extraordinary as well financially. So take a look. You can download a free report from our website, the College Money Report. In 5 minutes, you can learn on 3 different colleges you want to put in. You can learn what it's going to probably look like to pay. You can also find some options that might be a little bit cheaper. And then, of course, have a conversation with us to figure out what's best for you and your family.
Doug, thanks again for joining us. Always enjoy you having you on the show, and we're gonna come back on Friday, and we're gonna do this once again.
That's the show for this week. Thank you again for joining us on Money Tree Investing Podcast. My name's Kirk Chisholm, Wealth Manager of Innovative Advisor Group. We don't just manage your wealth, we make your life better. You can find more about me at innovativewealth.com, and of course, you can find me every week here on this show. You can also check out our show at Money Tree Investing Podcast. On our website, you'll have access to the show notes, resources, and the archive shows. Please remember to subscribe on our YouTube channel for immediate access to the new shows when they're released. When you subscribe to the show, it allows us to get access to some of the top minds of investing in personal finance. While you're here, please leave a comment and question if you want us to address it on the show. Have a great week ahead, and remember, no one will care about your money like you do, so invest in your life.